Hello, I'm Rob Morris, Global Head of Consultancy at Ascend by Cirium. Welcome to our first webcast under our new brand, and indeed our first ever webcast under this new model. In the past, we have delivered content to you on a quarterly basis via scheduled webinars. However, in this increasingly time-poor age where content is required on demand, we have decided to offer you the opportunity to consume our analytic content at your leisure, rather than asking you to join our events as we schedule them. We hope this model works for you. For now, I have selected my theme for today, some key takeaways from one of the air finance sector's key events of the year, which is ISTAT Americas. But for future events, we'd like you to help us define the content. So please feel free to feedback to any member of the Cirium or Ascend by Cirium team on questions you would like to see addressed in future events. But first, an update on the brand. Cirium enables customers to fund fleets, build and maintain aircraft, transport passengers and improve traveller service. We are here to provide you with data you trust and advanced analytics that you can utilise with confidence across your organisation. A vital component allowing us to deliver on this promise is the Pro Services division that incorporates the award-winning Ascend by Cirium brand. So without further ado, onto the content. Over the next 15 minutes or so, I will touch on the key thoughts that I took away from Orlando and the ISTAT Americas conference earlier this week where we had a large team in presence, which I think I can distill into these 5 key areas. There continues to be concern about a turning of the demand cycle, and most specifically the airline credit cycle. There was lots of discussion about 737 MAX and more generally next generation single aisle, not just as a consequence of the tragic events of 10th of March in Ethiopia, but more widely in the context of availability of aircraft through lessors from OEM backlogs. Wide-body demand, especially for previous generation wide-bodies including A330s and 777s, is cooling off as airlines become more cautious about adding capacity, and as 787s with Rolls-Royce engines are rapidly returning to full productivity. Lessors continuing to complain about the competitive scenario, including the still significant levels of liquidity out there looking to deploy capital in the commercial aircraft space, which they say are diluting yields. They are convinced that some element of consolidation, particularly amongst the smaller lessors, must happen, but also seem unwilling themselves to yield ground by reducing the levels of capital they themselves would deploy as they each continue their growth paths. And then finally, the appraiser panel failed to feature a representative from Ascend, so I'll present some of our views on the aircraft discussed there. So of course, the demand cycle and the associated macroeconomic, supply, finance and aircraft value cycles is something that we are asked about and thus opine about often. Back in January in Dublin at the Airline Economics Conference, I delivered a presentation covering macroeconomic and geopolitical indicators and what they are telling us about the cycle. And if you would like a copy of that presentation, please do get in touch. But in Orlando at the CEO panel, I heard Peter Chang of CDB Aviation note a lack of optimism, indicating that he was seeing some carriers in a fragile state and speculating that we may be at the start of a down cycle. Our macroeconomic indicators updated here would certainly support that view, with most indicating a slowdown in the global economic drivers, which are further at risk when one considers the geopolitical environment, US-China trade policies, Brexit, Venezuela, to name but 3 issues which are extant today. Yet our demand traffic lights do tell a slightly more positive story. Passenger traffic opened the year strongly, with IATA reporting 2019 January growth of 6.5% on 6.4% more capacity. We always like to see 3 or 4 months of numbers before we call a trend, but the positive opening to the year is a good indicator. However, cause for some pessimism is perhaps revealed in the comment from Peter Barrett of SMBC Aviation Capital. The airline credit peak has passed, which is evidenced in the airline operating margins line here, where 23 of our sample of 30 airlines globally have seen operating margins weakening year on year in the last reporting period. Drivers here are both cost challenges and yield weaknesses. Perhaps that growth is just coming at a cost. We also heard much chatter about specific airlines, with the CEO panel also noting that a failure of Jet Airways, for example, would immediately pitch 22 737 MAXes, plus of course a huge 737 MAX backlog into the market, which they said would be a worry. Which takes me quite nicely into the discussions about 737 MAX. In Orlando, everyone sensibly refused to discuss or speculate the causes of the tragic Ethiopian Airlines incident. But even before ISTAT, many were already asking if the MAX was harder to place in leasing markets than NEO, and those questions were magnified at the event. Cirium's Fleets Analyzer data suggests that there are presently as many as 60 MAX 8s in firm backlog with lessors scheduled for delivery this year, and a further 180 similar in 2020. Backlog and placement of lessor orders are notoriously challenging to research with full accuracy, so I think these numbers may slightly overstate the position. But I think the reality is that there may well still be around 40 such open slots in 2019, and certainly in excess of 100 in 2020. Similar A320 numbers do appear to be lower, perhaps giving credence to the question about relatively ease of placement. The bigger issue, though, is the potential impact on the market lease rate that lessors can realise for these MAXes. As of today, Friday the 15th of March for avoidance of doubt, our current market lease rate for 2019 build MAX 8 is $355,000. For information, we have the same opinion today for the A320neo. I guess the key question is, can this lease rate opinion sustain given the availability position today? Of course, this issue is developing rapidly, but as we speak, the global fleet of MAX remains grounded. The outlook is uncertain, so I won't speculate on how long the fleet will be grounded, or indeed deliveries would be suspended for. But the latter has significant potential for Boeing's cash flow. Over the past 3 complete months, Boeing has delivered an average of 32 new MAXes. But as production rate is heading upwards right now, and the backlog of NGs is almost exhausted, they were probably headed towards an average of 50 monthly in the next few months. Assuming our full life base value of around $50 million as the average achieved delivery price for the aircraft, that's potentially as much as $2.5 billion of delivery revenues lost each month that production is suspended. That's going to hurt Boeing and hurt the supply chain. So we will watch the situation as it develops and attempt to answer further questions as they arise. Back to ISTAT, and our third evolving theme is wide-body demand, where we heard questions and concerns about demand for current generation A330 and 777s as airlines perhaps exercise more caution about capacity growth plans. It is indeed a reality that secondary market availability appears to have ticked up in the last couple of months, as shown in the chart here. Notable additions to the market in February were 22 A330s at Etihad being offered for sale or lease, including 16 A330-200s. However, our Fleets Analyzer data also shows that the level of stored wide-body passenger jets in February, some 360 aircraft, was well down over the same month in 2018, where there were 430 aircraft in store. And at the same time, the fleet in service has increased to a total 4,530 today, again up 260 aircraft in 12 months. However, with Airbus and Boeing expected to deliver around 400 new wide-body jets this year, fleet growth will need to accelerate to absorb those aircraft in 2019. If it doesn't accelerate, then the flow of efficient next-generation 787 and A350 will pressure those A330s and 777s in the market. Hence the question. So rather like the MAX position, we will be watching developments closely and seeking out market data points to help our Values Review Board calibrate our market and lease rate opinions. Our fourth theme is the leasing sector and the competitive scenario. There was lots of discussion about the continued availability of liquidity across the commercial aircraft space. It seems that for airlines there has never been a better time to finance new aircraft, with capital markets and bank debt readily available at highly competitive rates to help source and finance new aircraft. And if that wasn't enough, according to Fleets Analyzer, there are also now no less than 166 known operating lessors with single and or twin aisle jet portfolios, either already deployed in the market or in OEM firm order backlog. The lessor CEO panel included comments such as leasing is in surplus, consolidation is a necessity, and we are starting to see some less sophisticated players leaving the industry. Our Fleets Analyzer data evidences that whilst the number of lessors indicates a highly fragmented market, the reality is that this market features high concentration. 78% of the portfolio managed by only 26 companies, with portfolios of greater than 100 aircraft each. Of course, we all hear tales of lease rate factor pressure as a consequence of intense competition, and economic reality is that price in any market will always be set by the weakest player. And thus it seems that those pressures are at play here, with the tale of 139 small lessors managing only 22% of the portfolio, but setting price expectations in the market that the dominant players struggle to control. So if consolidation is to occur, it will most likely be amongst those smaller players, either through mutual portfolio acquisition that could see consolidation to the medium-sized bracket, or through the larger players acquiring portfolios of smaller players as we see distress there. This latter point wasn't discussed much at ISTAT, but we are aware of several smaller portfolios potentially available in the market today, which could be the start of some small-scale consolidation. Again, whisper it quietly, because at present the largest lessors are typically in disposal mode as they cleanse their portfolios of less attractive credits or assets and also manage their concentration, but this is clearly an opportunity for those lessors. Consistent with the first three themes, since as the cycle turns and credit cycle worsens and single and twin R values start to see some stress, this is the time for those with capital availability and market expertise to exploit and start to build for the next recovery. My final point is the appraiser panel. Perhaps strange that ISTAT chose not to feature the world's favourite appraiser. We have won Appraiser of the Year 7 of the last 9 years, and also that with the most ISTAT certified appraisers, we have 7. But I do understand the requirement to offer exposure to more ISTAT member appraisers, and hence our lack of presence. But there were several points raised on the panel which I would like to address here. Early in the discussion, it was mentioned that demand for placement of mid-life aircraft is softening, and it is tougher to place a 737-800 now than it were 12 months ago. In general, we'd agree with this, and indeed, given the spare engine situation right now, this is potentially a positive, since the part-out market is buoyant at present and hungry for feedstock, which has proven sparse in the past few months. Ditto for the 737-800 passenger-to-freight market, where demand for feedstock to feed the emerging e-commerce sector, which is recognising the potential of the 800 as a freighter, is driving increased demand. But we should also recognise that any potential elongation of the MAX situation is likely to drive a small-scale resurgence in demand for any 737NG or A320 family aircraft, rather like 787 delays drove a small-scale resurgence in demand for 767, or indeed Trent 1000 787 issues last year drove some resurgence and recovery of lease rates on the A330. The quantum of the resurgence depends upon the length of disruption, so again I won't speculate here, but do watch this space. And then, availability is low, so the ability to absorb bankruptcies should be as easy now as it were in 2017, when Monarch and Air Berlin failed. Also, risk to values over the next 12 months of aircraft bankruptcies is minimal. These were two comments that appraisers made on the panel. Fundamentally, I don't agree with these. The market scenario is significantly different now from late 2017. Macroeconomics are softening and the demand profile is changing. The market did absorb those 100 plus aircraft with limited lease rate and value impact at that time. But if Jet Airways were to fail, then today the picture will be different, as per my comment earlier from the lessor CEO panel. Add to Jet Airways any other names, Avianca Brazil for example, and there the efficacy of Cape Town is also called into question. HNA Group, the risk to closure of the WOW deal, Norwegian, given the potential impact on them of MAX grounding, etc. Which leads to the second statement, where it seems to me that one or more significant bankruptcies would inevitably exert pressure on values and lease rates, as per our points 2 and 3 above, as aircraft that were placed into the market potentially surplus. Bullet 3 and 2009 A330-300 values and lease rates. Our half-life current market value for that definition, A330-300, is $41.5 million. So within the range of 38.8 million to 52.6 million quoted here, but towards the bottom end. Sadly, there was no discussion of the variance for those values, which I found disappointing since the elephant in the room had to be that variance. How can 4 appraisers opine with a plus or minus 15% difference on the mean of this range and not explain their opinion basis, which must include data point evidence? And ditto for the lease rates, where our present current market lease rate opinion is $340,000 for that aircraft, well below the range of $400,000 to $430,000 quoted. Again, I am really curious to understand who thinks this aircraft would realise $430,000 today, particularly given the data points we have captured and used to calibrate our opinion. And then the final bullet point I've chosen, A220 is a game changer. Yes, we agree. Airbus has brought strength to the programme and we expect to see more orders for the aircraft soon, plus an increased pace of deliveries. A bright spot amongst all of the doom and gloom discussed earlier. Which brings me to the end of this monologue. We hope that you like this new method of delivery and commit to bring more like this to you, covering commercial sector, helicopters and business jets, and delivered by a wide cross-section of our 27-strong team. If there are any questions that you have about this content, please don't hesitate to contact us. And similarly, if you have themes you would like to see covered, we would also be delighted to hear from you. Thank you for listening and goodbye.